Well, good evening, everyone. Welcome to Crypto Over Cocktails. Thanks so much for joining us. I hope everyone's doing all right, especially with lockdown 3.0 for those in Singapore. But yeah, we are very excited to be able to do this. I'm not sure about you guys, but I've heard about crypto for the last probably year or so, and I just don't know where to start when it comes to understanding it. So we're very, very lucky this evening to have Stefan von Hainisch from OSL, who's a sales trader here to kind of talk us through the basics and talk us through the kind of 101. So yeah, Stefan, thanks for being here.
Thanks very much, Raf, and big thank you to 1880 for having me this evening. A quick introduction to myself. I moved over to Singapore just under 2 years ago. Back then, I was still working in the financial industry, selling commodities and FX derivatives. And I realized that it was getting very boring, and the whole kind of crypto industry just became more and more prevalent, especially in Singapore, where the MAS is arguably the most forward-looking and inclusive governments and institutions when it comes to actually offering cryptocurrency as a trading method, as an investment strategy. But before I get into that, I would like to hand over to Josh quickly so that he can introduce the first cocktail.
Hey guys, I'm looking forward to learning a bit more about crypto as well tonight, actually. Not making too much money myself. So you should have two kind of cocktails in front of you. One is called Bitcoin and the other one is called Ethereum. Obviously based off of two crypto coins that I'm sure Stefan's gonna tell us more about. Bitcoin, what it contains, obviously it's plantation dark rum, as well as some Angostura bitters and a little bit of sugar syrup. So it's kind of like a rum old fashioned. So it'll be a little bit on the sweeter side, but the Angostura is there to kind of cut through and make sure it's not too sweet. The other one, Ethereum, like the coin, is kind of like a bit of an edgy child. In which case you've got Arquitecto tequila, you've got a bit of Aperol, you've got some sweet vermouth and some dry vermouth. And it's going to be a kind of mind blow in a sense. It's going to be a little bit bitter, but agave forward as well. On that note, I guess I'll pass it back to Stefan. I hope you guys enjoy the drinks and do feel free to share.
Thank you very much, Josh, and cheers to the first one. It tastes absolutely delicious. So yeah, let's begin right at the very, very basics then. What is Bitcoin? So Bitcoin is essentially it's a digital piece of code that essentially is finite, is defined through cryptography. Without going into too much detail, it's essentially computer code, computer science. And the way that it is coded makes it scarce. Now, when you look into the normal world and you look at fiat currencies, and by fiat currencies, I mean dollars, euros, yen, Swiss francs, Sing dollars, all that, it's actually very hard to kind of see or know exactly how much there is of it in the world. And of course, the other thing that we need to think about is that governments can print this money at a rate of knots. And that's what we've seen over the last 12 months, but more about that later. When it comes to Bitcoin, we know that there will only ever be 21 million created because that's how the code is written. Not only that, but we can actually go online and you can see in real time exactly how many Bitcoins are currently in circulation, where the price is, what the market volatility is, who's been sending money to whom, and vice versa. So we'll have a quick look at that to start with. Raf, could I ask you to share the screen, please, or allow me to share the screen?
Yep, done.
Thank you. So, which is the one that I want to show you? It is here. So this is a website, and just so you guys are aware, and like any website that I point you in the direction of tonight or anything like that, feel free to ask Raf for a link to it as well. They're pretty memorable. This one's called CoinGecko, quite nicely, and everything that all the information I have, it's all free, it's all available. And when I started kind of learning a little bit about crypto myself, and I'm very new to the industry, relatively new to the industry, I kind of started learning about it roughly a year ago. So it's been a hell of a learning curve since then. But all this is the kind of details and the websites that I've been using just to learn more about it. So obviously the most famous one, Bitcoin, is right at the top of the list. This is done in market cap order. So the largest coin by market cap is Bitcoin. You can see that it's currently got a market cap of about 725 billion. So the amount of Bitcoin in circulation times its price is equal to 725. You can actually go on it further and you can see you've got the total supply, you've got total circulating supply at the moment, 18.77 million roughly. And then you can carry on going down, you can see the news, and all that is super, super clear. And that's not something that you get in, if you were to look for US dollar, I mean, you know where the price is, but you have absolutely no idea how much there is in the world, who's got hold of it, how much they're holding of it. And this is something that is very new to Bitcoin, and it's a big appeal. Now, when we look at the circulating supply of this digital currency, you kind of wonder, okay, well, where's the rest coming from? How is it going to actually be made available to people? And this is where the miners come in. So the miners are essentially the computers or the processors that are responsible for looking after the blockchain. And the blockchain is essentially a decentralized ledger. So similar to how when you get your credit card bill at the end of the month from your bank and you see all your transactions, all the things that you've bought on that, that's the bank's ledger. So that's something that only you know about and that the bank knows about. And the bank will have thousands of clients. They'll keep a track of all this. And we're essentially trusting the bank to make sure that everyone gets paid what they're owed. Now, what does that mean? Now, it means you have the bank sitting in the middle. They're in full control. Not only are they in full control of who you can send money to, but they also, you have to trust them to be correct in everything they do. Now, the blockchain, on the other hand, whilst the bank centralizes all the information, the blockchain and miners the blockchain is essentially the decentralized ledger. So every single computer that is attached to the blockchain has a copy of this ledger. So let's have a look at how this ledger actually is. And this is the beauty of it. You can actually go into it yourself in real time and see how it looks. So if we're going on to, you go on blockchain.com, very simply, we'll go on to the Explorer. And what we'll actually do is just look at all the latest transactions. And here you can see in real time, all the different transactions comes through. The hash is essentially the ID of the transaction. You can see the amount, so how many Bitcoins were sent. You can see the dollar value of that Bitcoin. And it's very open for everyone to see. If you click on a trade, you'll also be able to see from which address the Bitcoin was sent. You can see to which address the Bitcoin is sent to, how big the transaction is, and what the cost of this is. And this is all open for everyone to see. So if I was to send a Bitcoin to Josh, for example, as soon as that trade was done, you would actually see it on this decentralized ledger. Now, somebody has to look after that and make sure that when I do send a Bitcoin to Josh, that does actually happen. And that not only that it happens, but also that when I say that I have a Bitcoin, that is indeed the case. If otherwise I could just pretend to be sending out Bitcoins and the whole system would fall apart. So the miners come in, and it's essentially their job to take these unconfirmed transactions and they will put them into pages, essentially, or blocks. So each block is essentially just a page of a ledger in the entire kind of Bitcoin ecosphere. They are paid, or the way that they make money is from two ways. You have the block reward, which is the payment that is made from the Bitcoin network to the miner when a block is verified and added to the end of the blockchain. And they get all the transaction fees that I just showed you. So for every transaction in that block, there's a small fee attached. And this fee, once the block is confirmed, is sent to the miner. And so let's have a look at how that actually looks like in real life. You've got the latest blocks. So far in Bitcoin's blockchain, there are 694,002. So that's currently at the level that we're at. If you click on that, this is essentially, remember, so this one block is just one page of this decentralized ledger. You can see all the different trades that have been confirmed by this miner in this thing. There's pages of it. I think it's like it goes down to about 50 pages. At the very first transaction in every block is the fee rewards from that block, which you can see, which are the individual rewards. And you have the block reward, which is 6.25 Bitcoin at the moment. So you can see when it's created, this new Bitcoin comes out of nowhere, or comes from the Bitcoin protocol and is sent to the miner. And that is how new Bitcoins are created. Now, you might be wondering, obviously, this takes a lot of energy. And you might have seen in the news that people like Elon Musk have been talking about how it's too there's too high energy consumption. The Bitcoin network uses more electricity than some countries. And this is to an extent true. And the process of verifying these blocks takes some time. And so there's always been that kind of question of sustainability. Should we be pumping this much electricity into the blockchain network? And the one thing that we need to bear in mind, and we'll focus a little about it later on, is what are the industries that Bitcoin is actually trying to offset? You've got the traditional financial industry, which has got thousands of banks, employees, asset managers, vaults, bank accounts, its entire network, which takes up so much more electricity than the blockchain. And additionally, it also tries to offset the impacts that gold has been having. And you might have heard how gold has been compared to Bitcoin quite a lot. When we look at currencies historically, gold has always kind of been used as a store of value. So historically, all the way back from the Roman era, gold coins were traded as a store of value to buy and sell goods and services. And this has always been the case. Gold and silver have been around for thousands of years. And this is slowly, in various forms, how money has developed. Now, it was only until the end of the Second World War, when there was a huge shortage of gold, that governments moved into this fiat currency system. So instead of valuing US dollars, British pounds, Deutschmarks, Swiss francs, instead of valuing those on gold reserves, they changed that. And they changed it from having a value come from a physical asset and changed it to a decree kind of legislated currency. That means that the currency has value because the government says it does. And initially, that seemed like quite a good solution. You know, governments are huge institutions, have lots of money, have the ability to print money. So chances are that if you're the US government or the European Central Bank now, you won't necessarily go bankrupt. However, that is always a risk. And we've seen countries, especially those in the lower developed, or those lower developed, economically developed countries in the world, when you look at Venezuela, El Salvador, Zimbabwe, where when the failure of a government completely leads to the loss of the value of the currency. And so whilst we're sitting in Singapore and we've got the MAS and the MOM looking after us, and you've likely got euros or British pounds or US dollars with reputable banks across the world in the West and in the US, not everyone has that luxury. And it becomes much more about self-control of the value or the assets that you have. And Bitcoin is something that does this. So when we look at gold, why was it used historically as a store of value? Well, it's it's finite. There's only so much gold in the world. And on top of that, it takes a long time to actually mine it, produce it, get it out into the market. And so it was something that it was an asset that could not really be inflated away. It's got inherent value. So it's used in the electrical industry, it's used in jewelry, it's universal. So it can be sent and it can be traded anywhere in the world. And historically, you used to run around with your gold coins, sell them in one country, it would be accepted, sell it in another country, and that would also be accepted. Gold is fungible. So you have one gold bar in the US. If it's the same size and proportion as a gold bar in India, they would have the same value. And you have the immutability of gold as well, that it's sturdy, it's physical, it doesn't change its form over the years. You can bury it in your back garden and it will keep its value. It won't change, and that means it stores value over a long period of time. Now, these are some of the reasons why it's always kind of been looked at as a good store of value. But there are, when you think about it, a couple of problems with those aspects or with those characteristics. Now, the first one being, it's actually not that easy to transport nowadays, especially not in size. You're not going to be able to go through an airport with $30,000 worth of gold in your suitcase. You have to declare it, you'll get stopped. And there's a lot at the borders of countries. There are a lot of restrictions into what you can actually bring in and out of a country. So if you can't move it yourself, then you have to think of a way to transport it. You're going to have to find a way to make it secure, probably insure it, hire security to look after it. And all this takes time and effort. And if you have to leave a country quickly, as has been the case in those where civil war is still rife and happens a lot, you're in a lot of trouble, and holding physical gold yourself can actually be very risky. Now, if you don't hold your gold yourself and it's with a bank account with a bank or in Switzerland in a safety deposit box, it's still relatively easy to seize. The bank has it, so whilst it is technically your gold, they could always shut the doors and say, sorry, no access. Or a government can mandate a bank to hold it away and make sure that you don't get access to it. And this is something that President Maduro found, that he was storing all of his country's gold, Venezuela's gold, in the safety vaults with JP Morgan in London. So he was like, my value is safe. I've got value there. And the UK government simply denied him access to it. And all of a sudden, whilst you have this value saved somewhere, you can't actually access it. So gold is pretty illiquid. It's hard to split and break down and send off in little pieces. So how does Bitcoin actually start to address some of these concerns? Well, when you think about it, Bitcoin it's finite, similar to gold. There's only ever going to be 21 million, as we saw. It's digital, so it's both everywhere and nowhere at the same time. It doesn't matter who you are, where you are, as long as you have access to the internet, you can, in theory, send however much Bitcoin you want that you own to any other Bitcoin address in the world. And that is done on this decentralized network on a peer-to-peer basis. So no one can stop you from doing that. The only person who would be able to stop you from doing that is your internet provider by shutting off your internet supply. But you can do it on a Wi-Fi, on the chip. You can do it absolutely anywhere. Now, the next point is that when it comes to storing your Bitcoin, how do you store it? Where do you store it? Who looks after it? And remember, this whole idea that we're trying to get around is avoiding banks, financial institutions, governments, and try to completely kind of remove them from the picture so that no one can actually have an influence of to whom you send value and when and how. So because it's digital, there are now certain devices in and around the world that you can get hold of. And one of them is this little guy. It's a Trezor. And it's literally connected to a computer with a with a cable. It turns on. You put in your own PIN code or password, and you can send your Bitcoin that you own onto this thing. Once it's on here, it's completely off the grid. And this is what's known as a cold wallet. So whilst it's not connected to a computer or to the internet, your Bitcoin cannot be touched. It's offline. No one can touch it. No one can access it. No one even knows that this Trezor necessarily belongs to you. And because Bitcoin is digital, you could store anything from £10 or $10 worth of Bitcoin all the way up to billions of dollars. There's an infinite amount of space of Bitcoin on this thing. Now, the best thing of all is that if you have this on your person, it's small, you're in complete control of it. You can plug it into anywhere with the USB-C cable. If you lose it, as long as you have your password and you have your safety phrase, you'll be able to buy a replacement device connected to the internet and actually unlock the contents of it. So even if it gets stolen from you, you don't actually lose your Bitcoin. It's if you lose it, doesn't matter, as long as you have your password. And that's the most important thing. As long as you have your password, you'll be absolutely fine. You'll have access to your savings at any given moment in time. You can move it anywhere at the click of a button. You don't have to ask anyone. And that's a huge appeal in my eyes to Bitcoin. Now, before we go on any further, I've spoken for about 25 minutes. So I'd like to hand this over back to Josh for a second to introduce the second cocktail. And if there are any questions initially about what we've spoken about so far, I fire them over to Raf, and we can address some of those.
Okay, yeah. So I hope everyone enjoyed the first cocktail, rightly named Bitcoin. Obviously, it's your second cocktail now is going to be the Ethereum one, unless someone's mixed up the order and started with Ethereum, then happily go into Bitcoin. But Ethereum, what that consists of is again an equal portion of tequila and Aperol. And then a bit of sweet vermouth and dry vermouth, and then that's it. So it's just kind of, you're getting your sweetness naturally from your sweet vermouth and your dry and your Aperol, sorry. And the tequila is giving it that little bit of punch with agave flavor, and the dryness is coming solely from that dry vermouth. So hopefully, I mean, as Stefan is, I'm sure going to go on and talk about, is Ethereum, obviously the name. It's kind of, for me, I haven't been in crypto long, but it's kind of like the middle child, I'd say, right?
Yeah.
I'll pass it back to Stefan, and he can explain a hell of a lot more than me. So,
thank you, thanks, Josh. Yeah, I'll go into a little bit of detail about Ethereum because it is important to know. Do we have any questions, by the way, before I do continue? Otherwise, we can open it up to the floor at the end of this as well. Okay, let's crack on for now. So, Bitcoin is being seen as a store of value, as gold. You can think of it almost as email, because you have an email account, you have your password and your login details to this email account. You can send your email to anyone else with an email address. Everyone knows what your email address is, but no one can actually send emails from your account unless they have your login details. So emails, so that's kind of a good kind of, I guess, analogy of Bitcoin. Now, Ethereum takes that a step further, and Ethereum, instead of just sending parts of code with value across the blockchain, Ethereum takes it one step further, and you can send what's called smart contracts through the blockchain. Now, this is essentially a function of ifs and whats. So if a car is new, if the color is red, then send over $18,000. And that can kind of be used as a form of payment for the car. And you can start kind of storing all forms of data whilst also sending value. So it takes it a little bit step further. If you think that Bitcoin is email, then Ethereum would be the computer that allows the email to be sent. So it opens up a huge number of possibilities of what you can actually do on the blockchains and how they're adapted, not only purely in the financial world, but also when it comes to supply chains, anything that needs the transfer of data to be done. Now, going quickly back to Bitcoin, there's two things that I really wanted to talk about towards the end of everything that I really had to say for today. And when you look at savings or cash or fiat savings at a bank, we've already spoken about in a little bit of detail how banks have control of who you send money to. Whenever you tap your card for a payment, you always have to wait whilst it says processing approved, and that's the bank allowing the transaction to happen. Now, that's kind of one big problem. You have this counterparty risk to a bank. Taking it a step back, you have the big problem that we spoke about was this exposure to governments. Now, a government can, in theory, print as much money as they like, especially in times of crisis. And so this is why over the last 12, 13 months since COVID, it was actually started spreading around the world, 40% of all US dollars in circulation have been printed in the last 12 months. Now, if you think that's not going to have an impact on retail prices or goods and services, then you're in for a shock, because by definition, the final resting place for money that is printed by the government has to flow down into the end products that are created. So if you are holding cash or any sort of short-term debts in your account with your bank, over the next year, 2, 3, 4 years, if they're not put to use, the value or your purchasing power of that cash will start to decrease. And you'll see this happening. It's already started happening. Everyone thinks that the stock markets obviously had a phenomenal year over the last 12 months. Everyone was like, wow, everything's just skyrocketed. But a lot of that has actually just happened because money has been printed by the government. And this is something we want to avoid. So talking a little bit about where the value of Bitcoin comes from. And we'll talk a little bit about the volatility as well. We all know that Bitcoin has obviously kind of grown from costing 60 cents and even less in 2010 to $38,000 where we are now. Now, the first recorded transaction for commercial purpose actually took place in 2010, where a chap in Miami bought 2 pizzas from Papa John's for 10,000 Bitcoin. That transaction today would be worth roughly $417 million. So quite some very expensive pizzas. I hope they tasted well. It was, and this is something that we'll see more often. You'll see news and stories about people spending Bitcoins in vast amounts earlier on, and then kind of realizing how the value changes over time. Now, where does something that intrinsically has no value actually get value from? You know, it's kind of a question. Is it a question of scarcity? Is it a question of belief, or kind of a network? And there are a couple of things that we can now analyze. When you have a mobile phone, and you only have one mobile phone, it doesn't really do that much for you. If you have 2 people with 2 mobile phones, all of a sudden there's a value that each person has. When you add a third, a fourth, a fifth person, suddenly the value of that mobile phone network, so to speak, starts to grow. And it's the same thing with Bitcoin. If only one person has Bitcoin, it doesn't really matter much to anybody else. But as that network grows, more and more people derive value out of it, because there is this belief that the Bitcoin that you hold will eventually be bought by somebody else at a higher price. When when you put that into perspective as well and think that there's only ever going to be 21 million Bitcoin in circulation, something that has a known fixed supply, and you have the ever growing printing of fiat money and a potentially unlimited demand, you start to see why this price starts to move so much, predominantly over time, to the upside. Now, of course, it's crashed massively. There's been 5-6 crashes where it's gone down by 90%. And this, I think, is something to bear in mind when looking to gain exposure to an asset that has relatively, well, that has literally no intrinsic value. We looked at the beginning at how the market cap is at 750 billion. It was estimated last week that there are no more than 200 million people in the world who currently actively trade in cryptocurrencies. That's a very small percentage. It's about 2.5% of the global population. Of course, we have to discount that there are people with no internet, no access to banking. So the people who could actually access Bitcoin, that number is actually smaller, but still, we're right at the beginning of this. And when you have banks only just joining the space, asset managers just joining the space, at the moment, it is people like you and I who buy that, and we are driven exceptionally much by emotion. That won't change. You will always try and sell something when it's not doing well. You'll always try and buy something when you've seen that it's been doing well. And by definition, that is something that will carry on creating this volatility. As more banks start investing into the space, as more asset managers do, and kind of more capital starts flowing into this market, and that market cap grows, we'll see that volatility reduce over time. The gold market is currently valued at roughly $10 trillion, which is something that we've been comparing Bitcoin a lot to. If you have Bitcoin's market cap at 750 billion, you can expect, or you would hope that, and none of this is financial advice, you would expect that over time, over the next 5, 10, 15 years, if Bitcoin wants to get to that same level as gold, the price by definition has to 10x from here. And I'm not saying this will happen overnight. I'm not saying it will happen at all, but these are kind of just some initial things we're looking out for, or that at least a lot of the crypto community is hoping for over the next few years to come. Now, similar to art and wine, watches, whiskeys, all those kind of various funky investment products and vehicles that people are spending their time with, none of those actually have that much intrinsic value either. A Picasso, a Monet, essentially is just a painting with some paint, a piece of paper, surrounded by some wood. The value itself comes from its scarceness. The fact that we know that there are only so many Monets, Picassos in the world is what gives it value. So applying this concept of scarcity to Bitcoin is actually not something that's foreign. Humans have always valued stuff that's scarce. And in that regard, it's actually something, or this isn't that new. Now, you have the other thing, one thing with gold is that we have to think of the Lindy effect, which basically means that the longer that something has been around, the more likely it is to be around in the future. So if a gold bar has been around for 1,000 years, it's likely that it will carry on being around. The opposite is true for humans. We are completely the opposite. The longer we're around, the more likely it is that we won't be around for much longer. But because of Bitcoin's immutability, because of the decentralized network that it's on, the fact that it's run by the strongest computer kind of network in the world means that the longer it's around, the longer it will most likely be around. And we've seen over its lifetime, over the last 10 years, where there's been hacks, attacks, it's been beaten down into the ground, it's risen back up. The more of these kind of obstacles, hurdles, and rites of passage in that sense that Bitcoin actually goes through over its lifetime, the more knocks and bruises it takes, the more likely it is to come out as the emerging winner on the other side. And it's still so far, no other cryptocurrency has gotten close to it. Ethereum is the second largest coin, but it's a third of the size. The entire crypto market is currently 1.5 trillion. Bitcoin makes up half of that, and we'll continue to see that over the next few months and years. That's really all I have to talk about today. I think it's time to hand back to Raf, see if there's any questions, and then we can crack through those.
Thank you, Stefan. Amazing. Okay, great. Any questions from the crowd? Josh, please go ahead.
Yeah, no. So obviously the portable ledger you've kind of got. I just wanted to ask a question about those as to whether do they only store Bitcoin on them, or do they store other kind of coins and crypto coins as well?
So it depends which one you buy. There's some more advanced ones where you can store literally any cryptocurrency you want. The way that the Bitcoin or some of the cryptocurrency networks run is they kind of have, to an extent, the similar sort of software. So Ethereum has its own Ethereum network. Bitcoin has its own Bitcoin network. A lot of coins, especially of the smaller ones in the altcoin space, will actually run on Ethereum's network or on the same type of software. Now, that means that any wallet that is able to hold Ethereum can, by definition, also hold all these smaller cryptocurrencies as well. But to start with, these guys, I think this holds 200 different coins. There are 8,000 coins available now today, with many more being added every day. For those coins that have been around for longer, there's a higher chance that they'll be available on these wallets, but they're improving every single day.
Okay, great, amazing. And then we have a question from Alison Kincaid. Please go ahead.
Hi, Stefan.
Hi.
Just want to say thank you so much.
Oh, I think we
You've
lost
muted
her.
yourself.
I think we've lost her.
Oh,
Alison?
no.
Oh,
No,
there
you're
we
back,
go.
you're back.
Oh, geez. I'm sorry. I'm on my phone. Yeah, I just wanted to say thank you first and foremost. I honestly had no idea about crypto, so this is super educational. But I was wondering if you were to start exchanging and you started building up quite a substantial wallet, as you say, is there a way you can get hacked? And if so, can you buy like insurance to get hacked, or how does that work?
So there are various custody providers available. You have Fidelity, which is a well-renowned fund manager. You have banks now getting active in the space and offering custody services. But the problem is, as soon as you hand your assets over to somebody else, you're automatically putting yourself at risk of them defaulting, or for whatever reason, them not giving you your cryptocurrencies back. And this is one of the things that we're trying to avoid, especially when it comes into buying cryptocurrencies. Now, the Bitcoin network itself has never, ever been hacked, never. And the only way that people have lost their holdings have been through human error, either by keeping their cryptos on an exchange, on a program that has in turn been hacked, or by letting their password slip, somebody getting hold of their password and thus having the ability to move Bitcoins or other cryptocurrencies off the wallet. There's a famous saying in Bitcoin and that in the crypto industry that says, not your keys, not your wallet, or not your keys, not your Bitcoin. And that's very true. As long as you're the only person who knows the password and you keep it in your head, you don't even write it down on a piece of paper, you keep it in your head, your Bitcoin will be safe.
Thank you.
Awesome. And then we have a question from Blair Hall. Hi, Blair.
Hi, Raf. Thanks. Stefan, thanks very much for that interesting presentation. You know, the infrastructure bill that was just introduced into the U.S. Senate this week proposes provisions that require brokers to report crypto transactions to the IRS. And it also would make any gains, maybe both from the coin holders and from miners, subject to taxes, capital gains. So if the US starts doing that, I think it's very, very likely you'll see other governments following and taxing and tracing these transactions. So, big part of your presentation was about how this is sort of outside government control. But the governments are not going to let that happen for very long, I suspect. And I think you're going to see a lot more tax consequences in these. How do you think that's going to affect the crypto markets going forward?
If there is a sustainable, if there is actually an effective way of monitoring the crypto markets and the people who trade in it, then I think initially there'll probably be a detrimental price, or there'll be detrimental price action where some might withdraw before they're eligible to be taxed. But at the end of the day, it is an asset, and every other asset that exists in the world will be taxed. Of course, there's a question of how much it should be taxed and whether those unrealized gains should be taxed. That's a whole different kettle of fish. But of course, if you're living in a country where you want to be living legally as a citizen with all the perks and benefits that come as being a citizen, then you do, or you should at least be living to the requirement of that government. Now, if that doesn't suit you, you can always leave and move to an area or to a country where those taxes will not be implemented. And this is the thing. You've seen countries such as El Salvador now state that they will be accepting Bitcoin as legal tender. It's been a huge, and there's no taxes there. Here in Singapore, there's obviously no capital gains tax either. So I think saying that governments will follow suit with the US, some may well do, but there will always be pockets of legislation in countries around the world that will do their own thing to try and attract as much investment in the space as possible.
Thank you.
Okay, great. Do we have any more questions? I think we have another one from Mr. Wilson.
Yeah, sorry, bombarding a little bit here.
Pleasure.
Stefan, I'm just curious, when it comes to cryptocurrency as a whole, do you think that large corporations or kind of industries will start accepting crypto anytime in the future, soon? After, for example, El Salvador recently accepting it as legal tender, and then Paraguay looking like they're up and coming to do exactly the same thing. What will make it become, I guess, essentially a worldwide currency?
Good question. There have been several reports in the news recently that have now turned out to be fake, of course, that Amazon would start allowing cryptocurrency payments. Now, Visa and MasterCard are already almost at the point where they allow people to pay for the purchase of goods and services online with cryptocurrency. And the way that currently works is that you will send your Bitcoin to MasterCard, Visa. They will convert it into the actual fiat currency that was kind of advertised for the product, and then send the company that made that product the fiat currency. But as the regulation around the space develops, as governments figure out how to account for it, how to tax it, how to regulate it, and you do need these sort of regulations and all this, you need this infrastructure in place to be able for it to be accepted as a global currency, as a reserve currency even. We can talk about that for hours. You will see more companies stepping in, whether if it's not to invest, then it will be for the payment services.
Thank you.
Okay, brilliant. Brilliant. Any more questions before we wrap it up here? No, I think if anyone has any questions that they think of after the session, please feel free to let any of the 1880 team know, and we'll get Stefan to answer them privately for you. But Stefan, thank you so much for your time, and thank you for having me, teaching us all a bit about crypto. And yeah, so hope everyone is staying safe. Thanks again for joining us, and have a great evening, and we'll see you soon. Thanks so much.
Thank you.
Thank you, Raf and Steph.